So why do companies implement stock splits, or why do they offer bonus shares? Why do they implement stock splits, or why do they offer bonus shares? So number one here is the introduction. So stock splits are, a common corporate action that companies take to adjust their share price without affecting the overall market value of the company. Understanding the reasons behind stock split can help investors assess their potential impacts. So number two, what is a stock split? A stock split occurs when a companies issue additional shares to existing shareholders. In Nigeria, we call it issuing bonus shares to existing shareholders. For example, a 2:1 stock split, shareholders receive one additional shares for every share they own, halving the stock price while leaving the overall value unchanged. If a company issues additional shares, you discover that the overall share price will decrease, and the market value will still remain the same. Number three is reason companies implement stock splits. What are the reasons? And that's what we're about to consider. Why do companies implement stock splits? Number one here is market share. It making shares more affordable. Making shares more affordable. When the company stock price rises significantly, it may become too expensive for small or for individual investors to buy. And so a stock split makes share more affordable, increasing accessibility for a wider range of investors. It makes the share more attractive. It makes it more attractive, makes it cheap. It makes it appear cheap anyway, and then investors would be attracted to buy. Number two, attracting more investors. Attracting more investors. In this case, lowering the price, the share price through a stock split can attract retail investors who might have been previously priced out, who may have previously considered the stock too expensive. So more investors can lead to higher trading volume, increasing market liquidity. So number three is improving market liquidity. Improving market liquidity. A stock split increases the number of shares in circulation, which can improve liquidity. So higher liquidity can make it easier for investors to buy and sell shares, potentially leading to a smoother market operation. Number four is signaling growth and confidence. It signals growth and confidence. A stock split can signal to the market that the company is growing and confident about its future prospects. So investors may interpret a split as a sign of optimism, which could increase demand for the stock. Number five, meeting exchange requirements. Sometimes, meeting, the listing requirement of the exchange might warrant companies undertaking, a stock split. Some stock exchanges like the New York Stock Exchange or the Nasdaq may require a minimum share, price for listing. So if a company's stock price falls below that minimum, it might implement a stock split to raise the price and remain in compliance with the exchange listing standard or requirement. In this case, they would implement what is called a reverse split. If the stock price is too low, they will carry out a reverse split, and that will increase the share price. And once the reverse split is the opposite of a normal stock split, in this case, the company could combine one or two or three. They can combine two or three or four or five shares into one, and that will increase the share price. Then there is psychological effect on investors. Psychological effect on investors. So investors, may perceive lower price shares as more accessible, or a better value, even though the total value of their holding remains unchanged. It doesn't really change the par value of the holdings. The entire effect is, is mainly psychological. This psychological effect can sometimes lead to an increase in demand and higher stock prices. Even investors were avoiding the stock when it was $10. In a case where the company, implement a stock split and the stock price is now, $2, 50 cents instead of $10, it might attract more patronage because they perceive it as being cheap, whereas nothing has actually changed. It's more or less a psychological reaction. Number 4, when do companies typically perform stock splits? When do companies typically perform stock splits? That's the question here. So it has to do with, the price differences. In this case, after significant price increases, companies that have seen rapid growth in their stock prices may split their shares to prevent the price from becoming too high and to maintain a decent level of liquidity. And not only that, in a case where there is a strong market environment, so companies are more likely to implement a stock split when market conditions are considered favorable, are deemed to be favorable, and that will signal a kind of strong market sentiment. And in conclusion, companies implement stock splits to make their shares more affordable. Not only that, increase market liquidity, and as well as attract more retail investors. While a company split doesn't really change the company fundamentally, everything remains the same. The intrinsic value of the company actually remains, the way it is. It can influence the market perception, and of course, heighten investors' interest. But essentially, the market value of the company still remains the same. So the entire activity is based on psychology to attract new investors and to keep existing ones happy and to give them a sense of wealth creation. So it's basically a psychological move, so to say.